Hi everybody, my name is Crystal Morris and I am a mortgage loan officer. I am doing informational video blogs to help my Facebook community learn more about the resources that are available for them as it pertains to mortgage financing, which is buying a house or refinancing your home. As a community mortgage loan officer, I get an opportunity to go to a lot of events that teach me about the resources that are available to people that the general public wouldn't have. As a result of that, I get a lot of questions from people looking for direction on where they need to go for down payment assistance and how they should structure their loan. The number one question that I get from people is, Crystal, how do I qualify for a mortgage loan? So that's what I'm going to explore today. Qualifying for a mortgage loan is threefold. You have to income qualify, credit qualify, and asset qualify. I'm going to talk about income qualifying today. When you income qualify for a loan, the bank is basically looking at the most recent 2 years income. So by it being 2017, we're looking at 2015 and 2016 income. The income documents that we're looking at are your W-2s, your tax returns, your most recent 30 days paycheck stubs, as well as your most recent 2 months bank statements. We need both your W-2s and your income tax returns because your income tax returns paint a clearer picture about your overall earnings. And people will say, well, doesn't my W-2 give you that information? Well, your W-2 or your, 1099 or whatever it is that you get will tell me what you earn from that particular job, but they won't tell me what you've earned from any other entity. For example, if you worked at Walmart, Walmart paid you $40,000 for the year. Your W-2 is going to show that $40,000. But what if in addition to that, you also sold Mary Kay? That your tax return is going to show me what that profit or loss from Mary Kay was. So that's the reason why we need both. In regards to your bank statements, we need that because we're looking for a habit of savings. We're also looking to see if you have any patterns of getting NSFs, non-sufficient funds, or overdraft fees. That's a bad thing. If you typically use your overdraft protection to help you cover your day-to-day expenses, you don't want to do that when you know you're getting ready to start the pre-qualification process for a mortgage loan. As it pertains to income qualifying, another question that I get is, well, Crystal, what if I have to switch jobs? It's okay because income stability trumps job stability. What I mean by that is you could have worked for Wendy's, McDonald's, Taco Bell, Kentucky Fried Chicken. As long as you keep enough income coming in order for you to maintain paying your bills and stuff, that's on time. That's on time, then that's okay. Some people have job absences. They want to know, what about if I have a job gap or a gap in employment? Typically, you don't want any more than a 2 to 3 month employment gap because that can cause issues for you. Now, there are exceptions to that, and one exception would be if a woman had a baby, and so she took her maternity leave, or, a spouse or a male had paternity leave. Then that's okay. What you want to do is try to return back to that same job. Now, if you drew a short straw and your job tried to fire you once you came back from your maternity leave, then the next best thing for you to do is to go into a job that was in the same line of work or in the same field. The next thing about income qualifying is self-employed people. A lot of people are looking to diversify their income and they're starting small businesses. And that's great. I think starting a small business is wonderful. I support small businesses. However, as it pertains to using that small business income to qualify for a mortgage loan, it gets a little tricky because the IRS allows you to write off your expenses, your business expenses, almost all of them. But when it comes to using that income to qualifying for a mortgage loan, it can bite you. For example, you decide to start a new t-shirt business, and in your t-shirt business, you show that you made $25,000. But you write off $20,000 worth of expenses. They could be completely legit expenses. But if you wrote off $20,000 worth of expenses and you only earned $25,000 for the whole year, then that means you only have $5,000 worth of income. That's all you can use to qualify for your mortgage loan. And in order for you to use that income, you have to have a 2 2-year history of earning that income. Some people say, well, I was on my job, at Walmart for 15 years, and then I quit my job, and then I started my business. Well, you need 2 years of your business. Even though you had the job at Walmart, you still need that 2 years of self-employed income. You still need that 2 years of self-employed income in order to use that for qualification purposes. And you want to be mindful about what you're writing off when you do your taxes. So hopefully that'll help some people who are getting ready, who are self-employed, who are getting ready to file their taxes, and they know that they're going to write some things off. If you know you're looking to use that income to qualify for a mortgage loan, you want to consider what you're actually writing off before you do it. All right. Well, thank you so much for listening. I do appreciate it. If you have any questions that you would like me to explore or do a video blog about, feel free to write that in the comment section, and if I get enough likes, then I'll be happy to do that. The good thing about being my Facebook friend is that many of my other Facebook friends are either processors, underwriters, loan officers, community development specialists, etc. So if there's something that needs a little more elaboration, they will comment. So looking at this video, it's almost like one-stop shopping. Thank you so much for looking at my video. I look forward to doing the next one. Have a good one.